All right, why don't we go ahead and get started? So thank you very much for joining. We're going to talk about performance and portfolio reviews today. I think a good topic as we come up to end of financial year where lots of people do that. But first, our little general advice warning. So anything you hear today is general advice. I obviously don't know anything about you. I can't offer personal advice, but would love some questions. So send through any questions you may have. So let's get started. All right. So why do we go through a portfolio review? Why do we look at performance? Other than the fact that, of course, we're obsessed with performance as investors. So what should a portfolio review be? Well, you don't want to do it too much. Obviously, you're going to look at your portfolio, but the real purpose of this and the real purpose of spending some time doing a portfolio review is to see if you're on track with your investment strategies and, of course, on track with achieving your goals. And one important thing that we'll talk about today is that as your circumstances change, we do want to, of course, look at our portfolio and make sure that the strategy is still correct for you. We don't want to do this too much because, of course, that can encourage tinkering with your portfolio and over trading. And that is a very bad thing for investors, a very bad thing in a couple different ways. Number one, because every time you trade, a question right off the bat. I'll get to that in 1 second. Every time you trade, there are potential for bad outcomes. So, of course, a bad tax outcome because you will potentially have to pay taxes if you sell an appreciated asset. There are transaction costs involved, both in selling what you are getting out of and buying something new. And of course, because over history of investing, investors tend to buy things that actually go down or go up less than the things that they sell. So there's a bunch of studies around there, a famous study looking at brokerage accounts in the US that have shown this underperformance of new investments we put in our portfolio. So we don't want to tinker too much, but of course it's good to check and see where we're going. And we'll spend some time talking about performance. So I won't really cover it here, but let's take a step back and look at where a lot of us look at performance reviews. And it really comes out of the way that professional investors go about looking at their portfolios. And of course, what they do is they compare performance against a benchmark. So let's walk through a couple different reasons why they do that, because I think we take a lot of cues as individual investors from professionals. And I at least think a lot of them are not applicable to the situation we find many of ourselves in. So number one, you are required to have a benchmark associated with your strategy if you're a professional fund manager. And this makes sense because professionals are generally confined to investing in a certain part of the market. And there are restrictions around what they can and can't do. So a simple example is you might be an Aussie large cap manager, which means you can't go buy some company in the US. So you are, of course, restricted. And that's a restriction that goes out in the product disclosure statement, the PDS. It's a restriction certainly that goes out in terms of marketing because investors that put their money with you want to know exactly what you're investing in. So it's very easy to have a benchmark then. And it's actually required that you have a benchmark if you are a professional investor, if you are a fund manager. The other thing is, of course, something that we're all interested in as investors. We have, of course, the choice of very cheaply going out there and accessing the benchmark in most cases. So if you are going to hire an active manager, what many people are interested in is this manager beating the benchmark? And most of us are long-term investors, but a lot of these benchmark performance reviews that occur are over short periods of time. And yes, a short period of time can also be a year. And the short-term performance is really important for fund managers because they, of course, are trying to gather as many assets into that fund as possible. And a key indicator of driving those asset flows is how a manager performs against a benchmark. Now, that is ultimately our problem as individual investors because we're very reliant on assessing managers over the short term to decide if we're going to put our money in, pull our money out. And that's some of that short-term trading I talked about. But because we're interested in it, we're the ones that are putting money into these investments, of course, they are very interested in it. And this can lead to a lot of problems. And the first problem is that a lot of professional managers, of course, have their investment objectives, but they also have their career objectives. So it causes them to hug those benchmarks. They don't want to deviate too far from those benchmarks because they know that if they do underperform and significantly underperform, even for a short time period, there'll be a lot of outflows out of that fund. And that's how their company makes money. So really, really important. Poor investor behavior drives this short-term viewpoint of investment managers. They'll all sit there and they'll all tell you they're long-term investors, but their behavior does not really dictate that. And what that means is that if they're very short-term focused, knowing what's going to happen if they outperform, the problem is, of course, that leads to more bad outcomes for you because they are more likely to trade a lot. We can see that despite this professed long-term orientation, a lot of fund managers do trade very, very frequently, which leads to those same poor outcomes because those capital gains get passed to you as an investor. So something to think about. Let me go through the next slide and I'll get to some of these questions. All right, so let's talk about you as an investor. So number one, there likely isn't a clear benchmark that you can associate with your portfolio. And the reason for that, of course, is because we want well-diversified portfolios. We want portfolios that have different asset classes in it, have different exposures within them. And so it's very hard to come up with a benchmark. So you may sit there and benchmark your portfolio against the ASX 200, but that might not necessarily correspond with the investments in there, which basically means that you comparing your portfolio to that benchmark is fairly useless. The second thing is hopefully you have a long-term orientation and a lot longer term than any fund manager does. And so that means these short-term fluctuations of performance, whether you outperform whatever benchmark you pick or you underperform that benchmark, it likely has very little impact on actually achieving those long-term goals. The other thing that's really important is what are we interested as investors? Well, we're interested in real returns. So those are returns above inflation, of course, because the reason we try to invest is we want to grow the purchasing power of our money. So we do care about inflation. And we also care about, yes, growing that money, which means we need to take tax and fees and transaction costs into account. Whereas you never see these in any of the performance that we're looking at from professional investors. So obviously the tax consequences are passed on to you and they can be very different, whether you hold this in super, whether you hold this outside of super, depending upon the marginal tax rate or marginal tax bucket you fall into. So they can actually calculate this, but that is really, really critical. They never talk about inflation, or most of them don't talk about inflation, but remember, we want to look at those real returns. And then, of course, transaction costs, they're less concerned with because, of course, they're trying to position their portfolio by trading a lot to try to make sure that they are not significantly underperforming that portfolio, or they're engaging in window dressing. And window dressing is simply them going out there and buying things that have done well so that when those periodic reports come out showing some of their top holdings, that you'll sit there and recognize some of those names. So all reasons why, and we'll talk about performance and how you can look at it, but all reasons why we need to not necessarily do what the professionals do as individual investors. All right, so we've got a couple questions. So we'll just get to some questions quickly. So, okay, so good question by Daniel. And he's looking at adjusting weightings on various asset allocations. I will get to that in a second. So if you could just be patient. Yeah, and I'll get to that second, and I'll get to that second question as well, Daniel, and I'll get to the selling question. Let me see, just one more. So another question from Daniel: how long do you give a managed fund? I give mine a minimum 5-year time frame, unless the fund manager leaves, and I'll definitely have a much closer look. The managed funds I use have a long-term horizon outlook. Yeah. So what you'll see with any fund is they will say in the PDS or marketing materials, or the product disclosure statement or marketing materials, they will say how long they think you should hold the fund. And so, yes, longer time horizons are better. The only thing I would say about that is a lot of them are still very short-term focused because most investors don't adhere to that. So, yes, I would encourage you, as Daniel said, I'd encourage you to look over longer time horizons when you're evaluating an investment. But just realize that also fund managers are under pressure to make sure that short-term performance is not too poor in comparison to a benchmark, because they know investors will leave. They know outflows will occur. So it's one of those things where you are definitely doing the right thing by giving a fund manager more leeway, but something to think about in terms of, well, what's actually driving their behavior. Okay, so question from Joan, which we can get to now. Is it reasonable to expect an index fund to regularly report on their performance? So you can look at performance, of course, every day. So you can go in there and check performance every day. Like, for instance, you can go to our website, put in a particular fund or an ETF, whether it's an index fund or not, and you'll see returns over various time frames. So whether that's a month, whether that's 3 months, et cetera. So whether the manager reports on that or not, remember the prices of an ETF and the prices of a fund are public, even if the holdings are not. So you can check on that performance really regularly. And, once again, I think kind of getting back to the comment that Daniel made before that, the problem with that is the more you look at performance and the more you assess that performance, the harder it's going to be for you to resist tinkering with your portfolio. Now, realistically, people are obviously going to look at their portfolio all the time. I completely get that. But just take that short-term performance with a grain of salt, because anything can happen. And certainly if you cannot answer the question why a fund or ETF or your own portfolio is outperforming or underperforming, then it's probably not giving you too much information in order to make a decision. But yes, an index fund, and typically an index fund, just so we know, an index fund at the end of the day should match the performance of course, the benchmark it has, because in that case, it's trying to replicate the benchmark, minus, of course, any fees that are charged by the manager. And then for you as an investor, minus any of the taxes that you have to pay, which will be distributed to you. So just a important caveat about index funds. Let's keep getting through this, and I think I'll answer some of these other questions, or I will revisit them. All right, so what do we think you should do at Morningstar? Well, we think you should track progress against your goals. And the point of this, of course, is how you perform against an index may have nothing to do with you actually achieving your goals. And we talk about a couple of examples. If the market happened to go down 10% a year, every single year for the next decade, and a fund manager managed to go down 5% a year over the same time frame, that's a great outcome for them. So they are beating their benchmark. They're beating it fairly significantly, right? It's only fallen half as much as the benchmark. They would see that as a very good outcome. You probably wouldn't see that as a very good outcome, because once again, you are trying to invest to earn a real returns or return over inflation. And falling every year is not a great way to achieve your goals. Or nobody I know has a goal where they are forecasting out, oh, I just have to lose 5% of my money every year and everything's great. So that's an extreme example, obviously, but it's still an important one to keep in mind. So what we really want to do, and what we've talked about a lot on here, is one of the reasons that you establish a goal is that you can actually calculate the return needed to get to that goal. And you can look at that return and look at the growth of your portfolio against that goal. And it allows you to assess how you're doing. So if you need a 7% return and you've managed to grow your portfolio by 9% a year, well, that's really good, right? It means you're making progress towards that goal. And just as an example of this is simply a screen grab from our website. And what you can see here is the original goal. In this case, in this example, this person needed a 6.51% return to achieve their goal. They wanted to grow their portfolio from 1.7 million to $3 million. They wanted to do it in 9 years, and they wanted to make no additional investments into that portfolio. Now, what's actually happened here? Well, if we go and look at it, and obviously I used data from a little while ago, but it's illustrative of this example. Well, they needed a 6.51% return, but when they set up this goal in November of 2020, by January of 2023, they had actually achieved a 7.68% return. Now, nowhere in here are we looking at benchmarks, right? What we're looking at is, what do we need to achieve our goal? What did we actually achieve? What does this mean? Well, it means if we recheck our goal and we just click on this part of our goal tracking tool saying updated goal, this will automatically recalculate this required rate of return based on how the portfolio is done. So now all of a sudden we have less time, right? So we have 6.8 years left. We may not know, looking at absolute numbers, okay, well, I had $1.7 million. Now I have $1.96 million. I guess that's good. I don't really know how to track that unless I look at this and recalculate this required rate of return. Well, it actually went down. So that's a really good thing. You were closer to your goal because you've driven that required rate of return down. You can make a lot of different choices there. One choice, you could sit there and say, okay, well, maybe I can get more conservative. So maybe I can dial back that risk a little bit. I can hold more cash because all of a sudden I need a lower rate of return. And remember, those asset allocations are going to be a huge driver of the returns you get, right? And once again, a simplistic example, if all your money is in shares, your portfolio is a higher long-term expected return than if all your money is in cash. So in cash, you're still going to struggle to get this return. Shares, historically, over longer time periods, you're not going to struggle to get that return. So it is just a good way of looking at things and bringing them back to your goal, whereas a benchmark can't really tell you that. A benchmark, and this does happen for long periods of time. If you go back and look at the decade of the 2000s and the US market, well, the market was actually down over that decade. And obviously a couple of things happened, right? We had the dot-com bubble burst, we had the GFC. So there's lots of different things that happened during that decade, but returns were actually negative. So they were barely negative, but still over a decade, that's not great. So really what we want to look at is then, okay, well, that's the benchmark. How did we do? And so I think this is a good way of framing it. And it's a good way of showing progress against a goal. And so many investors don't do anything like this. And then you just have these arbitrary numbers. So I had this amount of money. Now I have this amount of money. Is that good? Is it bad? Am I going to achieve my goal? People have no idea because number one, they don't have their goal. They never actually define how much they need. So that's one problem investors have. And then also one of the most valuable parts about investing is, of course, the impact of compounding. And so compounding, of course, is earning a return on your return. And I think a lot of people know that and they hear that. And, we've heard all these great things and that. I don't think he actually ever said it, but at least it's been attributed to Einstein that said compounding is whatever, the ninth wonder of the world or something like that. But really what compounding means in a practical sense is it means the biggest dollar gains that occur in your portfolio will be at the end of the period you're investing, right? So if I have $10,000 and the market goes up 10%, all right, well, that's great. So I'm a young investor at $10,000, market goes up 10%, I have $11,000. Now, whether that's good or bad, percentage-wise, it's pretty good. But if I have $1 million and my portfolio goes up 10%, then of course that's $100,000. So you get those bigger dollar gains, of course, further on in your investing time span. And so the problem is, it seems like, particularly when we're young investors or don't have a lot of money, it seems like we're not making any progress. Because at the end of the day, those gains from a dollar term perspective are very, very slow, but they accelerate. And like the Buffett analogy always talks about, like a snowball rolling down a hill that's just picking up more and more snow as it's getting bigger and bigger and bigger. Those gains happen later on from a dollar perspective. So it can be very hard and discouraging for us if we have this goal and we're told we need this much money for retirement and everything else. It can seem like we're not making progress, but that progress will really happen at the end. So another thing to think about. So I think we've got a couple more questions. I'll just pause for some of those. Okay, so Daniel's saying, what tool am I using to generate these figures? So I'm just using a tool on our website. So we have a goal setting on our Morningstar Investor website. We have a goal setting feature on that website, which allows you to put in your portfolio, allows you to set a goal, calculate your required rate of return, and then track progress against it, right? So as your portfolio grows, either through contributions or from gains, it does this automatically. So I'm just taking a screen grab from our Morningstar Investor website, and you can do this yourself as well. So basically, all you need is Excel, and likely, because it's very difficult to do this in Excel, to calculate that required rate of return, you can just go on and use an online finance calculator and do that same calculation, so that you can see, okay, what return do I need to achieve your goal? And you know, we've done a bunch of these webinars, or I've done a bunch of these webinars on goal setting, and why it's important to go through the process that talks about that. So Daniel, if you would like a copy of one of those webinars or some written content we have on that, just email me and anyone else, of course, and we can talk about that goal setting process. And one of the really important things about the goal setting process, I'll just quickly add here, is by calculating this required rate of return, you can see if your goal is actually realistic. Because I think the problem that some people run into is, of course, even if it's vaguely defined, they sit there and say, I want $1 million by the time I retire. But they don't bother to go through and think of, okay, well, what return does it take to get from where I am, wherever that is, to that end goal? If that return is 20% a year, well, you're probably not going to make it. And it just means, unless you're a lot better at this than I am. And what that means is you can go through and adjust the other inputs, because every input on here, and you'll see on this example, I haven't really filled them out, but every input on here is going to change that required rate of return. So obviously, if I have more money now, or I change what I want in the future, that's going to change that required rate of return. But also, and I don't have it on this example, you know, you're likely still contributing. So if you're still working and contributing to your super, that matters. Saving more matters. Saving more over very long time periods matters. So it'd be a lot better to figure out what you need to save when you're 30 versus when you're 64 and about to retire. There's not much you can do about it at 64. There's a lot you can do about it at 30. And you also see the implication of changing your time horizon as well, which will also change this. If your goal's further away, you need a lower return to get there. If it's closer, you need a higher return, everything else being equal. So yeah, something important to look at. And I do like the other comment that Daniel had. Every time I get nervous about performance, I grab an ASX 200 chart and zoom all the way out. Yeah, I think that's really, really important, because we become fixated on the short term, cause us to do things. When we get nervous, we do things, right? Investing is emotional just as much as any other factor that contributes to it. So zooming out, both literally by doing it in a chart or just sort of figuratively, is a really important thing. Okay, so we've got a question from Sergey saying, by taking losses, how is it affecting short-term and long-term capital gains and generally return of the portfolio? Yeah, so very simple. If you take a loss, you can, of course, use that to offset a gain you have in your portfolio. So, and obviously there are different rates for short-term and long-term. You do get that 50% discount if you've held an asset for over a year. But for the sake of this example, let's say you are looking at a long-term loss and a long-term gain. Well, you can offset those. So if you bought a share for $5,000, went up to $10,000, and that's a gain, and you sell it, you owe taxes. Depending upon your marginal tax rate, you will owe taxes on that $5,000. Then, of course, if the same thing happens, you bought a share for $10,000, went down to $5,000, you can offset both of those. So that's the good thing about losses, that you can offset some of the capital gains you have. Oh, well, thank you. Somebody answer that. How can I work out the return of an entire portfolio of different funds and ETFs? Yeah, so obviously you need to track that somehow. And so I think, as people are saying in the comments, there are various portfolio tracking software you can use that can track that. You can do it yourself. So for years, what I did is I just used Excel. So basically, and you can just do this you can do this by tracking it every day, or not every day, but you can use this by tracking it in Excel. You can use it by looking at statements. The one thing I would say where you run into a lot of return problems calculating returns, if you do not have a software like Sharesight to do this, is the problem is inflows and outflows of your accounts. So it becomes very difficult for you to calculate those returns if you are constantly putting money in or you're constantly taking money out, because that's, of course, going to throw it off. If your portfolio, it's very easy to calculate it. If your portfolio never has inflows or outflows, all we have to do is then sit there and we can calculate it off of the value at the beginning of the period and the value of the end of the period. But remember, those inflows and outflows and the timing of those matter a lot. Okay, so Mark's saying, where on Morningstar website can I find expected asset returns? I might actually have this up because I was trying to do something earlier. This would be convenient. Trying to be productive. Had a big day in the office with the fire drill, so that limits productivity. And we have a conference for advisors tomorrow, and I volunteered at it, and they assigned me to fill the fridge up with water. So they're really using all of my skills for that. All right, here we go. So I quickly moved over to our website. So where am I? So I'm on the Morningstar Investor website. I am on the investment policy statement. I'll show you where to get there in a second. But basically, if you fill out an investment policy statement, so this is defining your strategy, which we'll talk about in a second, what you can see is we've got three different things. You can set a target for your asset allocation. We've got all these different asset allocation models for Morningstar, and then we have expected return. So let's talk about what these are very quickly. So our investment management group models out returns, forward returns over a 20-year period that they expect to get from different asset classes. Now, a big driver of expected returns is valuation levels. So if valuation levels are really high, we would expect lower future returns, which you may see reflected in this. If they're very low, we would expect higher expected returns. So you can see them right there. And basically where you find the investment policy statement, so if you go on to track investments, and this is basically the tool that I'm talking about, you go into investment policy statements. I track two of them. So here's one. Emily wants to leave Morningstar. Emily's sitting in the room with me right now. She's worried because she was on camera earlier, but so if I go view IPS, there we go. This is Emily's desire to leave, and I just go to edit, and I get back to the screen, and I can see those expected returns. So anyway, let me now switch back to wherever that PowerPoint is. Sorry, I'm not very good at switching. Here we go. All right, so this is a really good way of looking at returns that you have, having some perspective around goals. All right, so the next thing we want to do when we're doing these portfolio reviews, and I know there's a couple other questions, which I'll get to in a second. The next thing we want to do, of course, is we want to review our strategy. And the strategy, very simply, and if we think about the goal setting process, we set a goal. We know what we need to achieve. Well, we know what we want to achieve. We know when we want to achieve it. We know the return that it'll take to get there. Next, we have to figure out, how do we do this? So what is our approach? So strategy can be very complicated or very simple. A strategy could simply be, I want to invest in low-cost index funds, and I want a certain asset allocation. So I want 90% growth assets because I have a long time horizon and I need a higher return. It can be very, very simple. So it's asset allocation generally, then kind of how we're going to do it in our approach. But periodically, it's good to go back there and revisit your goals. Now, one thing I always say to people, because I get this a lot, how can I set a goal, especially among younger investors? How can I set a goal for retirement when it's 20 years away? Well, we all know that your life changes a lot, your circumstances change, and what you want to do changes. But that isn't a good reason not to set a goal. You can always change it. When you're going through these periodic reviews of your portfolio, it's a good time to go back there and revisit what you want to do. So have there been significant changes to your investment goals? Well, so basically we can start thinking about these goals. And, we always make fun of them. I've got two friends who, one minute they want to move out into the country and start some eco lodge, and then they want to stay in Sydney, and then their goals change all the time. So it's good to sit there and think about, okay, has your goal actually changed? And a driver of a change to your goal, and it can be anything, any life decision that you make. Perhaps you're going to take time off of work. Well, that could impact your ability to achieve your goal. Perhaps you want to go take a new job in some exciting industry that happens to be lower paying. Well, that's going to impact your goal. Maybe you got a promotion at work and a big raise came with that. That could impact your goal. So along with looking at our goals, we want to look at, have there been significant changes in our financial position, right? So I mentioned a couple, changing job status. Maybe you got an inheritance from a long lost uncle that gave you a bunch of money. All of those things could, of course, change your goal. Changes in your life can, of course, change your goals. Maybe you became a parent. Maybe your parent needs to be cared for. And this could have an impact on your finances. All of these things can alter how much you save and invest. And that's where you might want to go in there and adjust your goals. Maybe you spent your whole emergency fund. Maybe you blew it at the casino and you need to build that back up, and that's going to impact your goals. So there's lots of different things that happen. So it's not a bad time to sit down and go through periodically a little checklist of your life. Have things changed in your finances, have things changed in your desires for what you actually want to accomplish. Because all of this is going to inform your strategy potentially. It's going to potentially change that goal, change the return you need, change the amount you need, change the time frame. And it's good to periodically sit down and think about it. And really what we're trying to do here at the end of the day is we're trying to provide structure around the way that we do things as investors. And a lot of this is what you would get from a financial advisor, right? That you would sit there and every time you meet with your financial advisor, maybe it's annually, and you'd sit down, they should, if they're a good financial advisor, talk to you about your life, talk to you about different changes of circumstances and your desires. We're just trying to put that structure around the process for a self-directed investor that's making the decisions yourself. Because as valuable as a financial advisor is, you can also do all of this yourself, right? This isn't magic, but what it takes is structure and actually sitting down and taking the time to go through this. I look at myself, I don't use a financial advisor, not that I have anything against them, but what I try to do is provide this structure, this framework, because ultimately that will lead to better investing decisions because you're doing things for a reason. You're not trading in and out of investments because your neighbor tells you something's a great opportunity. Might be for them, might not be for you. And you would know that because you've defined a strategy and approach that you're taking with investing. You're not just simply looking at performance of individual investments. And that's the way people generally do this, unfortunately, at least to some bad outcomes. People sit down once a year, they'll look at their portfolio and they'll say, oh, well, this ETF that I bought doesn't seem to be doing very well. Whether they're using any sort of basis for that other than it's gone up or down. And then they simply will go find an ETF that's gone up. And they'll figure, okay, well, I'll take my money out of this and put it into this ETF that went up. They'll go look at it a year from now without understanding why it went up and why your ETF went down. And maybe they'll do the same thing. They'll switch back into something else. And that leads to all sorts of bad outcomes. All right, so let's talk a little bit about performance. I know you've got some questions on this, and we'll talk about this. Okay, as I said, it's great to look at performance. And anyone can sit there and look at their performance, but really what we want to do, whether we're looking at a benchmark or not, and once again, I think there's some concerns about looking at benchmarks, especially if we have diversified portfolios. But no matter what you want to do, you need to understand when you look at that performance, you need to understand why, because you can't make any decisions unless you understand why. So looking at something against an arbitrary benchmark, yeah, maybe that's somewhat useful for you if you can find an appropriate benchmark. But if you can't answer the question why, you really should not be making any sort of investment decision off of that performance. So what is impacting that? Well, the first thing, let's look at some wider environmental factors. And these are obviously things we've faced. We've seen rising interest rates. We've seen still stubbornly high inflation. How is that impacting your portfolio? Well, it's going to impact different investments in different ways. So we need to understand that impact. And there's certainly a lot of information out there that you can seek, even if it's not immediately apparent to you, of what higher interest rates are doing. So very simply, if we look at higher interest rates, what does that mean? It means bonds have performed really poorly, because bonds, of course, perform really, really poorly in rising interest rate environments because interest rates go up, bonds go down. All right, so at least you have that context. At least you can look forward and say, okay, I'm not just going to sell this because it went down. I'm going to think about, where do I think interest rates are going to go over the long term? All right, so that's something you can do. What we've seen with rising interest rates is we've seen it impact valuation levels. And where has it really impacted valuation levels? Well, it impacted a lot of shares that were trading at very high valuation levels. So if we look at what happened last year, and this particularly hit the US market, and this can even be a comparison from the US market versus the Australian market, there were a lot of very speculative tech shares that were trading at high valuations. A lot of these darlings from COVID, whether it's Peloton or everything else, when we're never going to leave our homes and all the stuff we're going to do, Zoom and Netflix and all this other stuff, all did very well in the COVID environment. Rising interest rates dented a lot of those valuations, and investors got more risk adverse. Some of these non-profitable companies came down. So a lot of these companies are in the US. The Australian market's very different. All right, we've got banks and miners affected very differently by rising interest rates. So understanding that context is really important when you're looking at it, because simply rotating around and chasing what's performing well is not a great idea. We want to make informed decisions. And maybe your informed decision is that, okay, well, interest rates are never going to get to the level they were during COVID, where they were practically zero again. So I don't think these former high flyers are ever going to come back. At least you have a reason to look at that and reason then to interpret those results. So that's important. We also saw a big rotation from growth to value along the same lines, right? These growth shares that were trading at high multiples didn't do well. Value finally did well last year after underperforming for a decade. But it's important to understand that. If you are investing internationally, which we would certainly encourage you to have a portion of your portfolio internationally, how much are currency movements going to impact? How much have they impacted you? Right? So very simply, if you're an Australian investor invested in the US, and you're a US investor invested in the US, well, you did a lot better as an Australian. And you did that because, of course, the Aussie dollar depreciated last year, which benefits you if you're investing in US shares. Well, you don't get that in the US. So it's just a different perspective based on those currency movements. So understand what role that played in performance as well. It also provides that context. And then if we really want to get into performance and really want to spend some time, and Sharesight, for example, has tools around that, what is the driver? Which decisions did you make that are driving your portfolio overall performance? So one decision could be asset allocation. And we run into this problem when we start comparing a portfolio's performance with an index's performance. So if you're just sitting there saying, okay, I'm going to compare my portfolio against the ASX, and 20% of it's in global shares, and maybe you've invested some in bonds, it's not really an accurate performance comparison. But in that case, the decisions that would potentially be driving your portfolio are those asset allocation decisions. So whether you outperformed or underperformed, it could be those asset allocation decisions that you've made that have caused that. The other thing that can really drive performance is what individual holdings did you put in your portfolio? Are you a bad stock picker or are you a good stock picker? So if your choices, if you're not tracking an index, were your choices to go out there and buy BHP and not buy any of the banks, was that decision what was driving your overall performance? So was it you? Good or bad? Are you adding value by going out there and picking individual shares or not? It's really understanding that attribution. And that's really looking at, and it's also how much you've allocated to each one of those investments, right? We know that BHP makes up more than 10% of the ASX 200. So if you put 5% of your portfolio in BHP, then that is going to have an impact. If BHP outperforms, well, you're not going to do great because you only have 5% instead of 10%. If it underperforms significantly, well, it's going to be a whole different impact. So it's understanding, are you the one making the poor decisions that's actually driving this? And maybe in that case, it'd be better off if you did invest in index products or let somebody else make those stock picking decisions. So it's just different forms of attribution. But the really important thing is realize that over these shorter time periods, 6 months or a year, even the best investors are going to underperform sometimes. And even the worst investors are going to get lucky and outperform. So that's why we want to look over the long term. And I think we've got a comment on here related to this. So Peter says, if you have a long-term outlook, there's no need to expect any more than half-yearly reports from a managed fund. Shorter the reporting period, the more the investment manager invests for the short term and misses out on big gains. Yeah, so that's if you're relying on those reports. But once again, remember, there's always ways you can go in there and check. But yes, it is important to look long-term. And it is also important, the other thing that I would say, if you're looking at a fund, if you're looking at anything active, so it could be active ETF or an active fund, make sure that they are doing what they say they're going to do. Because as I said, every fund manager goes out there and says they have a long-term orientation. It's like part of the little job description, right? Because as investors, we know that's a good thing. So they just go out there and say it. And then you go and you look at portfolio turnover. And basically, portfolio turnover is how often are they buying and selling? And we go look at their portfolio turnover and we see that they're churning their portfolio almost completely every year, right? So if you have a portfolio turnover percentage of 100%, that means you're literally, and that's very high, you are turning over your entire portfolio every year. If your turnover percentage is 50%, well, still means you're turning over your portfolio every 2 years. I would call either of those things long-term. So there are some checks we can do, knowing that everyone says they're a long-term investor. There are some checks we can do to go in there and see if they actually are or they aren't. And turnover is a really good way of looking at that. Okay, so good question. What is a reasonable portfolio turnover rate? Well, listen, it's hard. It's hard to come up with a reasonable portfolio turnover rate. What I would say is, when I look at my own portfolio, I try to trade as little as possible. So I will have years go by where I don't trade anything, and that's because, I don't know, I'm very focused on trying to be a long-term investor, and I really don't like selling. So my default is I will keep things forever. And the reason that's my default, and Buffett says the same thing, and that doesn't mean I don't sell things, but what that means is having an action as your default will create a high hurdle rate to do something different. And that's what I wanted. When I was younger and I was looking at investing and looking at the pitfalls and some of the biggest issues with investor outcomes, it was trading too much. And so I didn't want to do that. So I sort of mentally put it in my head that I would hold things forever. Now, of course, that's not actually true. I do occasionally make trades in my portfolio, but that's sort of my default. So for me, I would want a portfolio turnover that was really, really low. And, when we're really, really low, we're talking 20%, 10%, things like that. Those are numbers to me that would resonate, but it kind of matters what your goal is and what the strategy of that fund manager is. And that doesn't mean that there are not people out there, and there certainly are. There are fund managers who turn over their portfolio a lot and are very successful. Just remember, that can be bad tax outcomes for you, stuff that doesn't get reported in their performance. So there are all these other implications. So there are some people that can do that. But for me, I think one of my biggest advantages is, as an investor, I hope, is what we call behavioral edge. And that's not making dumb decisions. And we have to remember that most of the time, and there's all these studies that show this, most of the time, investors who trade a lot are making dumb decisions. So every time you go out there, and remember, every time you go out there, if you look at all these these long-term brokerage studies where researchers have gone in and looked at what people actually are doing in their brokerage account, most of the time when people go out there and make a decision, they are making the wrong decision. And so I try to keep that in my head. And every time I go out there and sell something and buy something else, I try to keep in my head that most people doing this are making a mistake. And so that also hopefully gives me a higher hurdle rate. So I'll do it less and hopefully have more conviction in what I'm actually doing. So there's no right answer to what's a reasonable portfolio turnover rate. But it really has to do sort of with your philosophy of investing. I would argue that, almost all of the studies out there say lower is better. All right, so we're going to talk about asset allocation now. And we did have a question on this, and I'll get to the rest of the questions. All right, as I said before, asset allocation is going to have a very large influence on the returns that you get. Very simply, and I use that stupid example where you have 100% in cash or 100% in shares, you're going to get higher returns over the long term if you're 100% in shares. Now, your portfolio may bounce around a lot in value, but if we're just looking at returns, over the long term, that's what you should get. Over the short term, you can lose a lot of money. The market can go down significantly. But those asset allocation decisions are really important. And as investors, what we tend to do is skip the rest of this stuff because that's not fun, right? What's fun is going out there and trying to find some hot stock that you hope turns into some 100-bagger and you can, live out whatever your dream is. So we tend to skip to the end where we just want to pick investments. Remember, asset allocation decisions are really, really important. A really, really important driver of what the returns you'll get over the long term are, and also a really, really important driver of how much your portfolio is going to bounce around in value, how much volatility there is. Things like shares have higher volatility than something like cash. So these asset allocation decisions are really important. And that's why we want to set a goal for asset allocation. It's part of that whole strategy definition. And when we go and we do these portfolio reviews, it's also a really good time, and I'll share the website again. It's also a really good time to look at your overall portfolio against your goal. And so let me go back. So once again, I'm in this investment policy statement, and you can do this in lots of different ways. I'm obviously using a Morningstar tool. So this is Emily wants to leave Morningstar. She needs a lot of money to leave Morningstar, apparently. So she's defined her criteria and everything else. Well, that's great. But she can go and look at her target asset allocation. And then what she can do, I don't think I've attached this. Hold on one second. I think the retire early strategy, which might be Emily's approach also. Oh, sorry. I know what I have to do. I go back to the same screen I'm in. So what I can do is I can look at asset allocation. Because a portfolio is attached to this, I can compare my target that I've defined with my actual portfolio that I've loaded in here. So very simply, I want 20% in Aussie equity and I have 0. Oh, that's not great. I want 50% in international equity and I have 95%. So in that case, of course, I might want to adjust or rebalance my portfolio, because it's great to set a target for asset allocation. Very simply, you could have a target of 60% shares, 40% bonds, that classic 60-40 portfolio. But of course, market movements are going to change that. And so when we think about asset allocation, we want to make sure our portfolio does not get too far out of line. And I think that's where our question is on here. Somewhere in here, there was this question. Sorry, I have to look at multiple screens, so sometimes I get lost with the questions. Anyway, I think there's a question about how often, how you should think about rebalancing. Oh, that was somewhere in there. But anyway, yeah, so rebalancing, of course, is also going to potentially cause some bad outcomes. It's going to cause bad outcomes because with rebalancing, we generally sell things that did well and invest in things that did not do as well. So you're likely going to generate capital gains and there's transaction costs. So you don't want to rebalance too frequently. But there's a couple different ways of thinking about it. You could do this annually when you do these reviews. You could put a tolerance on there. So something gets 10% out of where you want it. You want 90% growth assets, and all of a sudden it becomes 75. That might be a time to rebalance. So rebalance is important sometimes, but we want to do that in a tax efficient manner. And if there's any way we can rebalance without actually selling things, we should try to do that. And you can rebalance without selling things. One, from income generated from your portfolio. Maybe you got a bunch of dividend income. Well, you could invest that in bonds. New contributions to your portfolio, so try to rebalance in a tax efficient manner. Just realizing I'm running out of time, although I think this is the last slide. So let me try to get to some of the questions we have. You can read the screen on what else is on there. Okay, so Daniel asked that question. Adjusting weightings on various asset allocations. Do you do it on 5% change or a time scale, i.e. annually? Yeah, it's up to you. So those are kind of the two different approaches. I would tend to say I would do it on a scale instead of just annually, because you don't want to rebalance if there's just small changes, right? If you have 91% in growth instead of 90, you don't want to make a change there because there is those bad outcomes. So I finally found that question, which is good. All right, let's see. What else do we have? What is the best strategy to decide to sell a stock? Okay, well, so what I would say is that in order to know when you want to sell a stock, you need to know why you bought it in the first place. And a lot of people don't really do that. So easy way to do this is to write it down. So what is your thesis for this particular share? Why are you buying it? So your thesis could be that I think lithium prices will keep going up because there will be a giant demand for batteries, and that I think lithium is undervalued because of that. Well, if you write down why you think that, then you can actually evaluate if it's time to sell, if that thesis changed. So why could that change? Well, let's say somebody was stumbling around in the woods of, I don't know, Brazil, and there was this giant lithium discovery, which was just as much lithium as we thought existed on Earth. And all of a sudden, that whole idea of lithium being a scarce resource goes down the drain and lithium prices fall. Well, you might revisit that whole view then. that you don't think lithium prices are going to go up anymore because there's so much supply. So really understanding why you bought a share is a great reason to come up with why you should sell the share. Because we tend to do arbitrary things. We just sell something because it went down. Well, that's not a great reason, right? Because the whole market could have gone down, all sorts of stuff could happen. That's once again that sort of framework and structure around why you were doing something. Lisa says with inflation fluctuating so much, it's hard to anticipate a total required return. It is, but remember, if we have a longer time period, what we're really looking for is the average inflation over that time. But yes, that does make things more challenging. That's why all of us want, especially as investors, we want low inflation, but we also want steady inflation. Makes things a lot easier, right? Central banks always talk about they want stability, right? And so, yes, we do want. It's very hard to invest when inflation is bouncing around. So that's a good comment. So Natalie says, where can I find the ETF portfolios that Morningstar publishes reviews every quarter? We're about to roll out something where you can find them a lot easier. Just email me and I'll send you the latest version, Natalie. So mark.lamonica1@morningstar.com. You can go and search and try to look for ETF model portfolios as well. Natalie wrote that twice. Oh, there we go. Okay, so Cherry says, Mark, you mentioned risk attached to, say, being heavily in BHP, light on bank stocks. Could you comment on AMP? Morningstar constantly raises in 4 or 5 stocks despite price going nowhere, no dividends. Okay, so let me say 2 different things. The reason I was commenting on BHP is because when you have very, very concentrated markets, and the Australian market is very, very concentrated, right? One holding makes up 10% of the ASX 200. The banks make up a huge portion of it as well, right? If you look at the big 4, they're somewhere around 25%. What that means is that if you are a fund manager, or you're going out there and you're picking individual shares to go into your portfolio, your decision on a couple shares is going to make or break your performance, right? So if I choose not to buy BHP, if I'm an active fund manager or I'm an investor that goes out there and chooses not to invest in something that is 10% of the market, literally the performance of BHP will probably make or break my year. In terms of AMP is a lot smaller part of the market. So it's going to have less of an impact overall when we're talking about that. I would agree that sort of our equity analyst, what you mentioned, thesis on AMP has not played out. So just like as we talk about our own thesis on individual shares, I would say that a stock that is constantly, and we do want to look over the long term, right? Our analysts are looking over the long term, but something that is constantly in a 5-star category means that their thesis has not played out. I guess that would be my answer to that question, Terry. So turnover rate can compare whatever you're looking at to vanilla index. Yeah. So remember, the one thing I would say is it is a really good comment about how you can compare turnover rate to an index. Generally, a broad index, so you mentioned BAS, of course, or IVV. So BAS is tracking the ASX 300. Generally, with broad indexes, you have very low turnover because the only turnover that would happen is basically shares that fall in or out of the 300 largest shares in Australia. So you can get very low turnover on the margins in some of those. So I would say that in that case, just remember that all active managers will probably have higher turnover than those broad indexes. But if you are really concerned about turnover, then maybe that's where you don't want to use an active strategy. Does Morningstar tool break down ETFs into their internal asset allocation? They do. So let me do a quick example for that. So what we will show is on almost any ETF, whether we cover it or not. So I'll just use that example. I think there are a lot of people in the hallway behind me. Emily's saying, yes, there are. So what you can do is, so we use Vanguard Australian shares, go into portfolio. So you can do this both on the investor website, or you can do it on just morningstar.com.au, and you can see all sorts of things. So these are Aussie shares. So we can see domestic equity, listed property. You can go through, you can look at sector allocation, you can look at region, you can look at country. We can look at top holdings. So this is what I'm talking about. It's tracking the ASX 300, more than 10% in BHP. You see the allocation. So for any ETF out there, you can go through and look at that same portfolio screen. All right, it's 2:00. I think I'm getting kicked out of the room, I suspect. But anyway, if anyone has any questions, email me at mark.lamonica1@morningstar.com. Daniel says, tell them to give you longer. Nobody listens to me. That's why I have to fill up the fridge with water tomorrow at our advisor conference. But anyway, thank you guys very much for joining. Really appreciate it. And send in any questions that you may have to my email address.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.